So let's start. We're going to talk about the latest trends on intragroup loans in Malaysia. And I guess the reason why we talk a lot about loans in various accolades is because loans is one of those transactions that frequently is misunderstood and it keeps evolving, and things keep happening in terms from an audit point of view, and taxpayers still have a lot of, I will say, gray areas that you kind of need to be doing a lot of cases to be able to come up with a conclusion, because I have to say I find that loans being one of those areas of transfer pricing that is very gray. And I think partly is because the e-tax guides are very limited when it comes to telling you what to do when you have intra-group loans. So hopefully today people can take some practical advice on it. For those who are new in our webinars, our firm specializes in providing transfer pricing advisory services to multinational companies in the Asia Pacific region. We have 4 offices: Australia, Singapore, Malaysia, and UAE. From those offices, we actually cater to the region. Having said that, we don't necessarily restrict ourselves to the region when it comes to conducting analysis, because we have access to databases to conduct analysis anywhere in the world, actually. So with that, let me just introduce our panelists for those who are not familiar. First, we will have Hon Chuan Tan, who has over more than 10 years of experience in transfer pricing and indirect tax. He has been a key important person to develop transfer pricing practices in Malaysia, and we're fortunately enough to have him over the past 5 years. I always say that when I cross someone who has been doing transfer pricing for more than 10 years, they are as crazy as we are, because not many people pursue transfer pricing as a career beyond 10 years, I guess, after doing tax and indirect tax. So that's basically a lot of wealth, and we're lucky enough to have Hon Chuan Tan with us for now 5 years plus. Needless to say that he has a lot of experience in transfer pricing projects, from planning, risk management, audit, documentation, country by country reporting, which I have to say secretly our country by country expert in our practice in all our offices, and obviously across all industries in the region. And for those who don't know me, my name is Adriana Calderon. I'm the lead partner for our Asia business, co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience in transfer pricing. Prior to that, doing domestic and international tax with Big Four mid-tier firms in different countries, different regions. Nevertheless, I have been in Asia Pacific for now 15 years plus. And clearly, the blue is one of the colors that I like a lot, because today I'm wearing blue and my photo is in blue. So anyway, besides that, Hon Chuan and myself do really love to share and give insights to all our audience. So we hope you enjoy our webinar for today. So I think the first thing we need to understand a little bit is how one approach intragroup loans and what is the localization aspects that are important in the context of Malaysia. Before we deep dive into this, let us just bring a quick poll to get people's views on this. So in your view, which is the key element to look when pricing intragroup loans? The options are contract content, TP documentation, benchmarking analysis, substance of the transaction, none of them. Maybe we miss what it is.
like very tricky answers.
Yeah. I would ask you, what's your take? Just heads up.
All of the above.
um, okay, let me just share the results. So it's very, very split. 55% content content, 32% TP doc, 55% benchmarking analysis, 68% substance, and no one answers none. So if you could pick one, Honchan, that's the trick. What would you say it is?
Well, I will pick benchmarking analysis by looking at the question itself, right? What is the key lens below to price, right? So I think pricing is the key word there, where we really need to look at benchmarking analysis and make sure that we price it accordingly. That's my take.
Ah, good. I will I will go towards contract contents.
Yeah.
I guess the reason why I say that, and maybe it's just because my background is law, actually, I do believe that in loan transactions, the contract tends to be one of the most important evidentiary pieces of documents when it comes to convincing your tax authority on your position.
Mm-hmm.
But it's good that we have different views, because if we had the same views, then we have nothing to say to the audience. So let's keep going with the content. So why don't you start giving us a little bit of an overview of intragroup loans, and what's the contents in which a multinational group will enter into contracts or group loan contracts?
Yeah, I think it's good for us to visit this transaction. And the reason why is because when we look at intragroup loans and putting in Malaysia's context, a lot of the time I'm still seeing interest-free loans, non-payable in the audited accounts, which is quite worrying. And intragroup loans nowadays is one of the key areas that has been scrutinized by the IRB, because now the IRB actually has that knowledge to really assess the intragroup loans. And really, we really need to look at intragroup loans in more detail, and it's really important to assess your risks in relation to these loans. Now, the other question would be, obviously, the existence of intragroup loans. Why is it there? What's the incentive for the group itself, right? Now, the first thing would be obviously to optimize, right, your external cost of borrowing. Now, there are various ways of structuring an intercompany financing, and generally, the entity with the higher credit rating would be your parent entity, whereby if the parent entity were to borrow from a bank, it would most likely able to borrow at a lower interest rate as compared to the subsidiaries within the group itself, right? So instead of having the subsidiaries to go to the third-party bank, the parent entity would be able to borrow at a lower interest rate and then on lend the loan to the subsidiaries, thereby optimizing the external cost of borrowing, which obviously leads to my next goal, whereby we're looking at reduction of external cost of funding. Now, if we are able to optimize the cost of borrowing and then not having the subsidiaries to go and apply the loan themselves, we are saving not just interest rate, we are saving administrative costs as well by centralizing borrowings itself, right? So that's important to actually reduce your external cost of funding. And then thirdly, we'll be looking at cash-rich entities within the group, right? So if the group has, you have proper governance in place, you have a clear view of the group's cash flow and the business operations within the group itself, then any of this cash can be then used to optimize the business operations within the group itself, right? The entity with excess cash can then be pulled up and then provided to the entity that actually required the most, right? Thereby optimizing cash flow within the group in its entirety, right? Generally, we call it a cash pooling exercise, right? And then lastly, it would also be a good tool to provide a flexible investment arrangement to achieve a good mixture of both equity and debt itself, right? We're looking at debt, but it'd be good to mix equity and debt, whereby nowadays it's very important to look at this because of the introduction of the earnings stripping rules in Malaysia, where you will need to then really assess the amount of debt you have versus the equity to ensure that you don't fall within the earnings stripping rules, or the amount of interest deduction denial is minimized accordingly.
That brings us to then one of the considerations always around loans, and is around two key things maybe that you could elaborate on. Why they tend to be targeted so much by tax authorities, and two, why is tax an aspect to keep in mind as well?
Yeah, so it's considered a high-risk transaction because a lot of the times taxpayers has been looking at having intergroup loan as a way to provide excessive interest expenses deductions in a higher tax jurisdiction, for example, Malaysia, while having excessive interest income in a lower tax jurisdiction, right? So there are a lot of taxpayers that are playing around the interest expenses part to obtain a higher interest deduction. Hence, it will then lower down the overall taxable position of, for example, Malaysia at a higher tax jurisdiction. Now, in Malaysia, as I mentioned just now, based on our recent observation, I would have thought that taxpayers would have paid more attention into their intergroup loans, but still, there's still a lot of interest-free loans that needs to be looked at. Every time I'm looking at audit accounts, I'll be looking at your advances, and obviously the note at the audit accounts will be saying that it's interest-free loans, non-payable, right? So these are the loans that we really need to scrutinize and actually relook at whether it makes sense to have interest imposed, right? So it really look at imposed on interest expenses part deduction and also interest income selection as well. So nowadays, the IRB is very well equipped with intragroup financing knowledge to be able to scrutinize these arrangements. So please bear that in mind. And we should also perform a debt and equity assessment to see whether there should be any reclassification of your debt or equity. And lastly, as mentioned, we need to consider the impact of the earnings stripping rules to identify any leakages of the interest deduction.
So, Honchon, if I was today setting up a loan, an intragroup loan, what will be some of the, if you could, the top aspects that one should look into? So today I want to extend an intercompany loan from Malaysia to a related party overseas. So what should I consider?
I guess this relates to the poll that we have earlier, right? So the steps undertaken. So if we look at the key aspects of setting out a loan transaction, the initial step is to ensure that the contract is formalized, but then you would need to then first perform a TP analysis, right, in relation to the intercompany financing arrangement. Now, the process involves first performing debt equity analysis to ensure that whether the arrangement that you're going through, is it a debt or is it an equity in nature, right? Then thereby looking at whether in substance it is a debt instrument. Now, after that, right, then you have a analysis, benchmarking analysis to determine the arm's length interest rate to be charged, right? So once these key elements are determined, it can then be properly documented down into the contract, right? So in terms of the benchmarking analysis, there are actually a lot of ways to come up with the interest rate, not just a benchmark analysis. That's where, you know, as Adrian has mentioned, the gray area lies. If you look at not just our Malaysian TP guidelines or the IRAS or other TP guidelines, the OECD guidelines in relation to intercompany financing actually provide a detailed analysis on it. Arm's length interest rate, which is rather complex in a way that there are other measures or methods in place to come up with the arm's length interest rate. Now, then by going through this process, then obviously you wouldn't have the substance overform issue in this place. So I would to emphasize that we need to get the contract is very important to get it formalized, to make sure that, you know, all of these are in place into one. Hence, yeah, generally these are the key aspects that we need to go through to ensure that when setting up the loan transaction, it is properly set up.
Thank you, Honchan. So let's look a little bit at the detail of the Malaysian approach, and we're going to go through some key aspects, but I think usually we like to talk about now two cases, which are probably the most important cases in Asia Pacific region. And even though they are not Malaysia based, they are the pillars, I will say, of how we will be looking at pricing debt in general. So the first case that is worth looking at, and then we will elaborate on how these aspects apply to Malaysia, is the case of Chevron that happened in Australia, whereby we had a funding vehicle being set up in USA that essentially issue some notes or some bonds to raise about 2.5 billion of USD. And the purpose of that raising was getting external funding and then on lending to Australia. So the problem with this whole arrangement was that it was a typical situation where on paper, everything looked quite correct or legally, because the company in the US was lending 2.5 billion at 2%. Then it decided to pass down the funds in the way of debt, not equity. I don't think it exceeded the debt to equity ratios, hence the reason why it could be treated as debt. And to set up the interest rate or the on-lending interest rate, they did a comprehensive transfer pricing analysis to charge 9%, which was around 7% on top. And that analysis was associated with the taking into consideration the Australian entity only. So now, why is this relevant? Because this brings 4 or 5 key aspects that it is worth also taking into account. This scenario could very well be Singapore instead of US, and instead of Australia, Malaysia. So exactly. The question here is, can I on lend, and I could have my funding vehicle being the bank in Singapore, or maybe via fundraising in the form of notes or shares, whatever it is, right? So the question is, if I would have this set up in the context of Malaysia, and let's say my US company is Singapore and my Australian company is Malaysia, can I at 7 basis points in the on-lending rate, right? So that's I hope is a question that we can answer towards the end of this aspect. So I guess the first question that one needs to answer is the substance of the loan. So the first question in our scenario here will be, okay, if I on lend 2.5 billion, let's say USD, or the equivalent in SGD, can I treat everything as a loan in Malaysia? That's point number one. So that brings me to challenge number 2, which is the value of the loan. Is the value of the loan supportable as a loan in the context of Malaysia transfer pricing provisions? The challenge 3 will be like, okay, if I think that the loan is in substance a loan and the value can be a loan, then what will be my interest rate? For that, the obvious way will be to do a credit rating of the borrower, which is the standard way in which one will price a loan. In the context of as an industry practice, if you go to a bank, that's how you will set up your the interest rate as the risk of default. So equally, you will do the same in the context of intercompany loans. And then the fifth aspect is it commercially reasonable and is not irrational? Because I could have a situation where maybe an independent party in similar situation wouldn't have borrowed the same amount or at the same interest rate if the market is showing that I should have done otherwise. So let's look first at the substance side of it. And that's where, for example, I'm a bit biased towards the contracts aspect, because I think this is where the contract is extremely important, to have very clear terms of a loan. So key things will be the presence of a fixed repayment date, what is the purpose of the debt, if there is some securities, right to enforce payment of the principal, the obligation to pay interest, and some consequences if there is a failure from the borrower to repay, or if there is a change in the payment date. So, and the reason why this is important is because a lot of the times what we observe is that this first aspect is not covered properly. And then when you have something that doesn't have an obligation, a clear obligation of paying the principal or paying interest, then you open yourself for arguments from the tax authority to say, well, a third party in this scenario wouldn't have considered this a loan because you actually don't have an obligation to pay neither capital nor interest. So that's why a lot of the times when we get asked to review contracts, this is the first thing that we actually check. Or when we do contracts ourselves, this is one of the first things that we check, right? So maybe this is a bit of a extremist example, but it shows what it is a loan versus what could be not a loan. So let's assume that we have here a company A located in country A that channels some funds. Let's say that the company A is a leading manufacturing company, channels some funds via equity and debt into the finance entity, country B, in a low tax. And then that finance vehicle again channels down to Malaysia entity in which is company B. And the total funds are around 100 million at 8% interest rate. And the loan says that the tenure is 100 years, no repayment clause for principal, maybe not clause for enforcement of interest rate, and is only required to be paid when it makes profit. So the question that one brings here is, okay, if company B wants to deduct all the 8% of interest rate payment to the finance entity, would it be allowed to do so? And that's my question to you, Juan.
Yeah. Okay. So I guess in relation to what you have said earlier, contracts and in substance, is it a debt, right? So key thing here is I'll be looking at the terms, right? 10-year, 100 years. Would independent party in normal similar circumstances will be entering into a 10-year, for example, 100 years? Would there be repayment clauses for principal, and would a loan arrangement allow an entity to pay? I would love to have that, but to pay only if it makes profit, right? So based on these commercial reasons, in terms of whether an independent party would be able to on loan or treat this as a loan, and based on that fact, or maybe other facts as well, that it may not be a loan in substance, right? So what's your take in this?
No, I agree with that. I think it would be so obviously you will have to look at the definition under the Income Tax Act of Malaysia, or what is considered loan versus debt. Most
debt versus equity.
Yes, debt versus equity. So most income tax act will have that definition, but based on our experience, we have done this so many times in many countries. One will really know that these start sniffing very much like equity. So if the company gets caught after lodging the tax return in Malaysia and is challenged, I will agree with you that it will struggle to justify a deduction of 8% interest rate. So that brings us also to another point, which is the value. Let's assume that, for example, that that agreement that case that we just saw about, which is 100 million loan at 8% interest rate. Let's assume that the contract was properly done. And then the contract says that company B has to pay within certain terms, and these are the repayment installments and the interest rate, etc., etc. What will be then the issue around value, I guess? Would there be some arguments around the borrower being able to borrow that 100 million? What is your take on that?
Yeah, I think that is also a key question that we need to ask ourselves, right? Looking at the value itself, whether the borrower in that particular circumstances, because it really depends on the industries, in relation to the industries, are a lot of economic factors in place to understand whether this 100 million is that the norm? Is that something that a normal independent party in similar circumstances would be able to lend and or borrow that amount of loan, right? That's something that we need to justify.
Yeah, exactly, because I guess coming back to what we talk in Chevron and now, so we could very well say that, okay, maybe my company, if it's on a standalone basis, is so risky that should pay 8% interest rate, right? But then the question comes about the value. If you're so risky, would you go to the bank today and being able to ask the bank to give you 100 million loan? If you consider yourself so risky because you're paying a high interest rate, obviously I'm talking about interest rates, maybe not now because now has gone up a lot, but I'm talking about at the time that it was a lot less. But let's assume that interest rate was 20%. Then the question is, but would someone be willing to lend me that amount of money? So that's where the value also needs to be attended to before the price as well, because obviously if the value is irrational, that no one will be willing to lend me that amount of money, then I also have a second reason to potentially be challenged on the fact that basically my transaction is commercially irrational.
Mhm.
And I guess there is another aspect which you will gonna talk in the other slides, which is around the limits on interest deductions and earning stripping rules that we do have in Malaysia, and that's something that needs to be looked into very thoroughly, I guess. Then, as you can see, if we keep elaborating on that case, so we said that we are lending 100 million to a Malaysian entity. So we have to make sure that the contract is in nature of a loan and make sure that it's not equity in nature. Then we're talking about the value and that is not commercially rational as well. Then if all those tick in, the question is, okay, now transfer pricing, the price, even though I always say transfer pricing, price is not always about the price. Yeah. That's the catch of transfer pricing, as you can see here. So now the price. What can we do to price, or what are the common avenues? So obviously, one of the things that you were talking earlier, Honchan, is that we could have access to external data to prepare, to do what we call a comparable uncontrolled price. And that external data can be in the form of either bond yield curves or interest rates published by the reserve banks, or looking into third-party loans as well. And then we also have the other avenue, which is the possibility of looking at my external cost of funds as basically guidance to set up the Intragroup interest rates. Because in theory, the group cost of funds, like economically, or that's what some of the tax authorities believe, that the group cost of debt is very close to what each entity will pay if they were going to go to borrow externally. So obviously, on the cost of funds approach, there is a little bit of a more conservative outcome, because it leaves not that much room to do a lot of intermediary on lending rates. So that's why a lot of the times when you have like big debt being channeled or big funding structures being channeled, you might end up more towards the cup to be able to kind of spread out the interest rate properly in the multinational group. I don't know if you have any other points here, Honchan?
Yeah, in relation to pricing, because we do have really huge clients where they use not based, they actually follow some of the OECD intercompany financial transaction guidelines, where one of the methods was economic models, right? Whereby it's a bit scientific. So obviously the general rule is that you have a base rate plus margin, right? So the margin is where they have a scientific formula to come up with that margin, right? By going through a currency swap, the spread based on number of years of the tenure, and based on the publicly available bonds. You have country risk premium, and then obviously adding on other handling fee, right? So that's where, when the group have a pricing policy in relation to the loan itself, it's really important for us to actually tell them that the testing and the management may be different, right? Really in relation to the respective jurisdictions appetite in pricing or testing the intercompany loans, right? So that leads to the main point of what you have mentioned in the Chevron case. The Chevron, they have gone through a borrowing, Australian borrowing, which is a BBSW plus a margin, right? Then one of the key verdict of that is that we have to look, not just looking at this economic model where you use a base rate plus, but you also have to take into account the cost of fund. The group cost of fund plays actually a big factor for the tax authorities to come up with whether the disparity between your group cost of fund versus what you have in your pricing policy, does it make sense or not? Because a lot of times that obviously for us, pricing it arm's lengthly based on the economic model may make sense. But at the same time, really, we need to not just look at that, but also to use other factors to make sure that we have to think about the tax authorities' point of view as to what other ways they will use to test the rate itself. So I think it's really important to keep in mind that, oh, I have a group pricing policy. The group comes up with this interest rate. It is arm's length, but it may not be the case depending on the jurisdiction. So
that's a good point, because I guess the take on that is that if you have a group policy, that's great. It's a great starting point, but then you need to also double check that it works from the Malaysian point of view.
Yeah.
Right. Just for information over here, when we're doing some external cost or external type of analysis, one, we have to do some credit rating of the borrower, a benchmarking analysis of the interest rate, some comments around demonstrating that the intercompany loan is commercially sound, meaning it is not irrational. And generally what we follow is that the preliminary analysis is performed at the time that we enter into the loan. Having said that, one has to track it, because when there is big changes in the economic circumstances, like we are facing now, for example, increases in interest rate, then you might have to renegotiate some aspects of the loan. So if we look at this example, let's say that we have a third-party bank that lends to a head office that is in a low tax, and that is channeled via debt to company B located in Malaysia. So in this case, what we have is a bit different, which is a tenure of 5 years, USD 50 million, LIBOR plus 1.5%. So from a Malaysia point of view, I guess the first question will be, will this transaction be subject to mandatory documentation in Malaysia?
Yes. I mean, if interests are imposed, and yeah, for Malaysia, if you have like provision of advances and all that, especially with the amount of like 50 million, but in Malaysia it's more towards provision. So now here is a receipt, but still there is a controlled transaction in place. Hence, you will still need to have a TB documentation in place to actually test this transaction, the loan transaction itself.
And is there some threshold in Malaysia, or for the purpose of mandatory documentation?
Yeah, for a fully fledged TB documentation, it relates to provision of financial assistance, the other way around, of above ringgit Malaysia 50 million, right? That is where you really need to assess the whole the value of the transaction, the entirety of the loan itself.
Okay. But if you're below the threshold, you still have to do simplified documentation.
Yes. So regardless, you still have to have a TB documentation in place.
Okay, got it. And then what would be the avenues here from Malaysia point of view, just looking at what we have discussed earlier about pricing? So my first question will be, does Malaysia has any indicative interest rates that it publish every year and accept as a correct interest or a market interest rate for certain type of loans?
Yeah, for Malaysia, No, we don't have a indicative margin provided by Malaysia to, at least for taxpayers, to rely on as a guidance in relation to interest rates. So yeah, I guess we have to then lean back to other methods, like for example, cup method or group cost of fund method to reassess the loan itself.
A third
Yeah,
question is,
yeah.
if this country A was Singapore
Country, yeah.
head office,
Mhm.
and I use, and okay, this 50 million, so it's a bit too high. So, but let's assume that I could use the indicative interest rate that Singapore allows to do so. Is IRB obliged to accept that interest rate?
No, definitely not. So that's the caveat, right? So IRAS may accept, but Malaysia will not. They will do their own analysis to come up with whether the interest rate is arm's length or not, based on their perspective, right? That's the issue with having cross-border transactions.
Well, that's the issue that keeps us I guess with resolving complex and interesting issues.
Yep.
So just to spin things around, I thought before we enter into the earnings distribution rules, I thought we ask, given that we have the influx of AI, I thought I asked ChatGPT. So why are loans and financial transactions a point of dispute with tax authorities? And look what ChatGPT thinks. So ChatGPT thinks that loans and financial transactions can be points of dispute with tax authorities for several reasons, primarily related to a potential tax avoiding and profit shifting. Here are the main factors contribute, and then it starts talking about, like, again, substance, value, and a few other things. But I have to say that it talks about things very theoretical. So I give it to ChatGPT that they do know that it has to do with tax avoidance and profit shifting. But I think when you ask ChatGPT, but how, that's where ChatGPT fails to give you answers. So maybe why don't you talk us through the earning stripping rules? Because I think apart from the normal transfer pricing and getting your loan contract correct and your pricing right and your value right, I think this is an important consideration because these rules do limit your deductions in Malaysia. So can you just tell us a little bit about what they are and how they operate?
Yep. So in Malaysia, the earnings stripping rules introduced back in 2019, effective I think 1st July 2019, and then after which it was amended to be effective 1st February 2022. And the amendments is more in relation to added more definitions towards the qualifying deductions, as well as the computation of the allowable deduction, as well as the interest expenses and other minor amendments. And this earning stripping rules is actually in line with the OECD-based erosion and profit shifting, the BEPS Action 4, where it's on limitation on interest deductions, right? So it limits the base erosion through the use of interest expense by way of excessive interest deductions, or to finance the production of exempt or deferred income, right? That's the main goal, right? They're trying to tackle this issue that has been quite rampant, especially cross-border transaction intercompany loans. And the aim is to actually limit the interest deduction, and then obviously the slides before first.
Oh, okay, sorry.
Just to emphasize on, in Malaysia's point of view, also it's only focused on cross-border loans and not domestic loans for now. And then the last point would be that it also applies to third-party loans outside of Malaysia, but guaranteed by the holding company, regardless of the location. So we'll go through some examples later to sort of give you some flavor of the earnings stripping rules. Now, the next slide would be the key features. So the first one was on and after 1st July 2019. Then there's an amendment where some of the definition will be effective 1st February 2022, which we are well after that already. And the scope is that, the interest expense incurred in respect of the financial assistance between related parties, right? There are the control transaction scope there. Generally, it'll be the 20% shareholding and above, right? You'll be caught under the control transaction. And then, as I mentioned, the third-party loans outside Malaysia guaranteed by a holding company will be within that scope as well. And as of now, it's 20% fixed ratio in relation of the tax EBITDA. So that's the 20% ratio in place. There is a diminished threshold on this, which is 500,000 ringgit in total, regardless of the source of the business funding. So that's 500 ringgit. So 500,000. So if you're below that, that's fine. It doesn't apply to you. And then any excess interest expense can be carried forward into the subsequent year for the subsequent calculation of the interest expense, or rather the allowable deduction. So next will be, I'll go through an example just to illustrate what it means in relation to earnings stripping rules, more so to look at whether ESR applies. There are actually two scenarios here. So first up would be holding company X providing loan to subsidiary Y, and then interest expenses are being paid to holding company X. Now, the key point of ESR is that it really depends on the source of the fund location, right? So in this case, if the holding company is actually outside of Malaysia, then ESR will apply. And if both these companies are within Malaysia, that's fine. ESR is not applicable. The next scenario would be if subsidiary Y borrows from a third-party financial institution outside of Malaysia, but then even though holding company is in Malaysia, but the holding company in Malaysia provide loan guarantee to the third-party bank outside of Malaysia for the purposes of on lending, for the purposes of subsidiary Y borrowing this loan, and that subsidiary Y provide paying the interest expense to the third party, right? This will still apply because the third party financial institution is actually located outside and loan guarantee was provided for the purposes of this loan, right? So in this scenario, then ESR will still apply. Okay, yeah, next one, I won't be going through the full detail. If you want to look at how to calculate the adjusted income, the tax EBITDA, adjusted income, qualifying deductions, as well as the interest expense, the IRB website will have a full guideline as to how they calculate the adjusted income line by line item, as well as the qualifying deductions, as well as the interest expense. So the formula is that you have the tax EBITDA equals adjusted income plus qualifying deduction plus interest expense. So bear in mind that in 2022, the qualifying deductions definition has expanded, so that you have to reassess on the definition and making sure that any of the deductions are actually included inside as well. So once you have gone through the tax EBITDA, now remember back, the fixed ratio is actually 20%. So 20% of the tax EBITDA will be your allowable interest deduction. So if you look at the gray one, interest expense, right? So the allowable deduction minus the interest expense, if it's above, then you have a set amount of interest expense denied, right, which can then be carried forward to the next year. And then to add on, for during the calculation where you reach a negative tax EBITDA, right, that is treated as nil, right? So which means that you have nil, you most likely have an allowable interest expense, which can then be carried forward to next year.
Thank you, Hongchuan. So maybe let's move to the questions. There are quite a few, given that we have about like 7 minutes.
Okay.
So let's move to the questions. Give it seconds. I open the questions. So give me 2 seconds. I just open here. Okay, so let's start with the first question. The threshold of 50 million in financial assistance provided, whether to prepare minimal or full TP documentation, is it on a yearly basis or overall balances?
Yeah, so for this, right, it's when you have that provision of 50 million, straight away you have that full TPD analysis. Now, then obviously the next year you're just updating it. But if there are any business changes or any changes to that particular loan, then really we need to reassess, right? In particularly in our era where, you know, from 2020 to 2022, where, you know, there's a fluctuative, or rather not fluctuative, like really increased in interest rates, then it needs to be reviewed. And since it has already been done in a full TPD format anyways, more so to reanalyze that particular financial assistance. So generally speaking, you still need to review it up on a yearly basis.
Okay. Someone asked a question here, which is interesting because we didn't talk so much about the lender, but it says to confirm, TP rules only apply to the lender and not the borrower, yes? So that's actually incorrect. TP rules apply to both the lender and borrower, hence the reason why it's a complex issue. So when we were talking about like the company in Singapore lending to Malaysia, you kind of have to look at it from the lender point of view, which is Singapore, and from the borrower point of view, which is the Malaysia. So it applies to both lender and borrower. There is another question here, which is, if the source of the funds for the loans given are from the company excess funds, which is invested in FD. FD is fund deposits or what?
Fixed deposit, the fixed deposit
okay.
rate, I guess. Yeah.
Can the company use the fixed rate to charge the borrower using the opportunity cost of funds? That's an interesting one.
That's a case-by-case basis. So really depends on the, I guess you have to go through the list again, the factors of the loan. Why is it being provided? Purpose, you know, you have to still have to go through. We can't say that you can use that FD rate. So it really depends, but it's interesting.
I actually think that you cannot. My first impression is that you cannot, because the borrower is not a bank. So if the borrower is not a bank, then the fixed deposits is meant to remunerate someone for the lowest risk possible, because it assumes that I go and deposit into a bank. So my borrower is never going to be a bank. So I think that assumption is not correct, actually.
Well, I guess it's not about the rate. I think it's more about the use of the FD rate. I guess you can use it, but you can use it as a guidance. That's the minimum rate, the opportunity costs.
Yeah, but I reckon my first impression is that you cannot use it. You have to do something else, because a fixed deposit is for depositing your money in your bank, I guess. But I agree with you that is something that needs to be looked at case by case. But my first impression is that it cannot be. I receive advances. I receive advances from a company limited by guarantee, which funds comes from donation and charities. Does it consider related party transaction? The members of the company limited by guarantee are also our directors. I receive advances from a company limited by guarantee, which funds comes from donations and charities. Does it? I receive advances from a company limited. What do you mean by I? Is I a person or a company?
Most like an entity, I guess.
I receive advances from a company limited by guarantee. Okay.
But
does it consider the members of the company limited are also our directors? I think they are related party by in common management.
yeah, so I think the rule of thumb is that the TP rules or the control transaction doesn't just apply to entities alone, right? It applies to the definition. So really, most likely will be under a related party.
Yeah.
Barring is satisfied the control transactions with the directors.
Yeah. So we have one time for maybe one more question. Let me just put this one. So if I were Malaysian borrower of 50 million from a Singapore company, I will still have to put a TP documentation in place. Yes,
Yeah,
right?
you have to have the TP documentation in place to a certain extent, I guess.
But even
you need to have TP documentation.
Even from Singapore point of view, 50 million ringgit, let me divide it by 3.4, is almost 15 million. So the chances are that from Singapore point of view, you will also have to do.
Yeah, I mean, for Singapore, because Singapore is a lender, right? So from Malaysia's perspective,
wouldn't you have to do because the borrower also has to will claim some deductions?
Well, yes, you would have to have TP documentation in place. Yes.
Yeah, because you will have some deductions, so probably you will also have. So they
what if it's an interest free? So
interest free. Okay.
Yeah.
So I wish I had a coin or not a coin, $1 million every time people ask me this question because it's so debated in Singapore.
Yeah, that's why I can't put an answer to this.
Yeah, because in theory, Singapore, I know what you're saying. Like if it is interest free versus interest bearing, I guess the Singapore point is always like if it is interest free, from pure TP point of view, you have to justify as to why it's not a loan in nature. Because if it is a loan in nature, then it has to have interest, basically. That's the point.
Yeah.
Okay, so I think that's pretty much what we have time for today. For those of you who want to reach out to us, we have our details at the end of the slides, which you can see when we send the recordings. Please like and subscribe in our YouTube channel. There is a lot of interesting material. And we have one last webinar. I think Honchon and I are a bit webinar out for the I think we need to count, we need to make a stock take of how many Zoom hours each of us have, under our belt for 2023. I am inclined to say that I could very well have done more than 100 hours.
Yeah, I would say so.
So please join us for the last webinar. And if you want to reach out to us, here is our details, our Malaysian email address. But if you want to reach to any one of us, you can just check the websites and you can reach out. So Honchon is very happy because he's going on leave tomorrow. So Thank you, Honchon, for coming, despite of going on leave and taking the time to present today, despite of your busy.
My pleasure.
Thank you.
Thanks, Adriana.
Bye.
Thanks. Bye.